Hi everyone, time really flies. We are getting into Q4 of this year. In Q3, we look at the financial markets globally and we can only see negative returns, and also the non-US dollar currency are generally quite weak against US dollar. Except two things is going up. One is the interest rate, the other is the energy prices. I take 23rd August 2022 as the cutting point for calculation some of the price changes and indices changes, and this is mostly negative. As you can see from the chart, that interest rate went up quite a lot. The US Treasury 10-year government bond interest rate have been exceed 3%, and also the crude oil price have jumped more than 20% during this period of time year to date. So our cautious quarterly macro and financial market views are proven correct. So we have no change in our readings towards the global major financial dynamics and markets. And if you have no investment convictions at the moment, you do not need to force yourself to invest. And maybe you should put your excess cash into time deposits and enjoy life, at least for a while. If you are in Taiwan, you can visit trendy restaurant in Yinan, such like this in the picture. It's owned by my friend. Or if you are in Hong Kong, you can visit my friend's solo art exhibition in Prince Terrace, Miss Xin Ying Low's solo art exhibition. Regarding our Q4 financial market outlook, 4 key points. First point, we are still bearish and feel very challenging economic condition ahead in Q4. So it is time for you to do more research, but no need to hurry to invest for mid and long term. The second point is the global liquidity withdrawal is continuing, and we will see a higher CPI. Because of the high interest rate in US, so we see US dollar will stay mostly stronger against other currencies, and also US interest rate is still on the upward trend. So we still cautious against the liquidity sensitive sectors such as the new economy and the cryptocurrencies. The third point, China financial markets need to consolidate further. And if China is having a recovery, Hong Kong definitely will benefit from it once it happened. So again, it's time to do more research, but no need to hurry. The fourth point, deglobalization trend is intact, and we see a lot of uncertainties. Short term, no solution for Ukraine-Russia war. China, Taiwan, US always have quite high tensions on these sovereignty issues. So financial markets remain vulnerable to all these potential shocks. There are 4 investment concerns for us in the Q4. The first concern is we are still difficult to justify high valuation stocks and some of the crypto plays. The high valuations is under great pressure to devalue. It will turn cheaper. and so also the liquidity favor assets will also suffer as a result. Second concern is the argument for owning higher yield stocks during an interest rate uptrend. This argument is getting weaker and weaker. The third point is rising bond yields and the REITs. Also, I think we see better opportunity under stress valuation. So we can wait for better opportunity at this moment. The fourth point, because of the negative mark-to-market impact on assets, so it affects the long-term investor investment appetite. So it will further dampen buying. And we see margin calls on borrowing, such as mortgage loans, even on individuals, is happening. Recent event worth noticing. One is the very talk about ESG investment. When we see Google Earth app and you see North Pole, South Pole, you will find out the ice cap is getting smaller and smaller. It is a hard fact. So ESG theme is solid, yet it's difficult to turn into profitable investment at this moment of time for most investors. Second point is the foreign exchange rate against US dollar. If we see the cutoff point is 23rd of August and we take year-to-date changes, so it's mostly weak, and these weaknesses meaning the real purchasing power of this money or these currencies are getting weaker. The third issue is the energy crisis. So we see, because no imminent solutions we see with clarity, so Russia-Ukraine war will be dragged, and we will see elevated energy price for quite a while. So of course there are some opportunities for the energy crisis beneficiary, but it's not for everyone. The fourth point is the food crisis. With extreme weather pattern, no cheap food is expected, and the elevated transportation costs, with all the complexity, higher food price should be the outcome. So what to take note for your asset allocation in Q4 and for your investment planning? So we are planning for a very gradual rebuilding of equity holdings, as in the long run, high quality equity exposures could hedge for high inflation. But as I said, not in a great hurry at this moment of time. The second point, we should search for growth REITs or good value bonds. Is also at some point of time would be a good hedge for high inflation as stress valuation. But I think it's coming, but not at the right time yet for buying aggressively. Third point is you should think about lowering your intrinsic gearing or your borrowing in your investment portfolio, and you should have a diversified currency exposures, especially for non-US dollar as a home currency investors. The fourth point is for retirees and very risk-averse investors. No need to undertake excessive risks or under great pressure to invest, because it's difficult to get the market trend right at this moment of time, and you have the luxury of waiting for the right time. There's really no hurry. So what conscientious investor should do at the last quarter of the year, no different from Q3 homework, review your existing total portfolio, re-examine your absolute loss tolerance on each asset class, and adjust your asset or your risk position accordingly. You should review your asset allocation and reposition your portfolio according to your updated loss tolerance. Always search for mid and long-term investment targets in different asset class, and you may set target price for accumulation. If there are excess cash, and because you do not have enough investment convictions, don't mind to park in time deposit for a while, and you will feel more happy and more relaxed to do investment research. And one of my friends have given me a very interesting and common question, talking about how to guide the next generation in managing their own wealth to avoid personal wealth crisis going forward. No matter you give them 0 cents or tons of gold, my following advice would be valid for you to share with your next generation. The key words is with good risk control and a humble lifelong learning attitude, everyone can safely sail through all kinds of stages in their investment journey. I classify there are 4 stages during one's typical investment journey. Stage 1, beginning stage, everyone should start to learn. Usually you learn from books, family, friends, or some role model in the media. After learning a bit, then warming up stage is you will heat up when you see the reality, all kinds of cheating, big scale, small scale, personal, corporate, and then you read through the newspaper, magazines, and we better have them learn from others' mistakes. The first stage is really you have earned some money, then you're practicing real investment. So again, it's crucial at this stage to learn minimum decent investment and financial literacy. Of course, it's from good intention sources, not just brokers that want to generate turnover. So that is the third stage. And the fourth stage is close encounter of force majeure. It's always everyone should have the experience, personal, corporate, or non-personal aspect to encounter something totally unexpected. And this is part of our lifelong investment journey. So it is always a learning, for everyone. So let's see more with this picture. In the beginning, nobody know anything, whether your kids want to learn from you, learn from others, but anyway, have a start. Usually you need to learn from something, someone, books, family, role models. Well, when you see the reality of this world, then you would see all kinds of cheatings. So you can learn from others. There are many tactics, good, bad, rumors, whatever, but we better learn from other people's mistakes. Then you have accumulated certain wealth, money, then you do the real investment. Typical one is buying a home, high purchase a car, all kind of investment, JV, or startup, that is something real. Then we will encounter some sort of unexpected event, force majeure. So it is a must for anyone to come across something totally unexpected. And as I mentioned, the asset is not only the physical asset, but your wealth, your health is also your wealth. So something to learn with. So a good risk control after weights, the give and take, up and down, then you should have a good risk control mentality and not only attitude but actions that we always mentions in our video training. Then as a result of all this, you have a reasonable return with all these risks taken into consideration, and then most of the time you make more gain than losses, then that's fine, then you can sleep well. So what tactics individual investor will use to avoid wealth traps? Interestingly, a lot of my friend mentioned a lot of recipe or tactics for next generation's self-earned asset or inherited family assets. I list it out so you see whether it is useful for you. Like cautious against any addiction, that is definitely important, and it seems like for me it's like you're saying not put all eggs in one basket. So not to absorb in anything, stocks, people, some games, and it will cause concern by other people. That is no good, definitely, And then some parents like to transfer ownership title of some asset to the next generation only after their death. That means they would have something to work on with their will. It is something good. It's not to comment good or bad. It's just a way of handling. But it doesn't stop in the future any loss of asset value. Someone also say partial transfer, also let the next generation experience management, also a good exercise. It's up to personal situations, that you think appropriate. Again, when the total asset transfer happening, there are also no insurance or assurance that would not have big losses going forward once the asset management is totally transferred to the next generation. Also, liquidation, someone say, okay, if the kids have some sort of divorce, then they should divest the asset back to parent, liquidate, and then we build a portfolio afterwards, Again, there's no guarantee would not lose in some other ways. It is a way to avoid something. So I have to remind you that the free financial market can easily generate losses over 50%. And you need something that you are on top of all this happening in order to avoid major losses and then can enjoy good gains, and overall in the long run you have more gain than loss. I think that is important. So this come to the last point is I would encourage all the next generation to have proper education and a decent investment and financial literacy. This is the only long-lasting and all-weather strategy for your next generation to avoid any crisis. That's our view. Thank you for your patience.